Good morning, everybody. Sorry for the delay. Had to restore my workspace and things just didn't start up like they should have. So I had to cancel stuff and wait. And anyway, sorry I'm late, guys. Thanks for hanging in there. And of course, stuff's already happened. Dowie Mini has already come up. You can see it right there hitting its targets. So hopefully if you guys are trading that, you were prepared and you're able to get in. Dowie Mini, one and done. How many times do we see that Monday morning? Right out the gate. Nice winner. Thank you very good, Johnny. Good morning, Miles. Crude oil also was a quick winner this morning. Lots of trading. Crude oil up over $4 already. And don't forget, we're in the K contract, May. The May contract that happened last Friday. I have to go back a couple screens to get to the first trade of the morning. This one here, which set up about a minute and a half before the start time, but then right at the start time, you could see it came down right in this zone, right there, for a chance to grab it, and then popping up to a perfect target one, 23 cents, $230 a contract. So a couple nice trades to follow also, but more than a couple. 4 more winners in a row there, but the work is already finished. So crude oil done, Dowie Mini done, unleaded gas. Thought I switched this, but I guess it didn't save. Okay, so the pound Aussie. Was there another trade? Looks like it's got a short right there. Yeah, the pound Aussie now short. Anyone interested in a Forex trade? Short at 77.69. It's targeting 77.58, 51, 44, and 37, and the stop's at 77.88. There it is. I spoke too fast. You can read it off the data window. So, unleaded gas off to the races also. Not really a move that you can catch there. The first trade of the morning comes here at 9:12. And that one zooms down and picks up that first primary target of 49 ticks before stopping out at break even. A blue trade here, which you're going to want to adjust it a couple ticks, a little bit above the blue line. You don't want to trade up into resistance, especially with an action move down and a reaction. You never want to get in on a reaction if you could avoid it. And the blue line's a perfect line to help you adjust around to avoid getting into a pullback or a reaction trade. Instead, you get a subsequent action move to the downside. So you got a couple action, reaction, subsequent action, smaller ones, and that combines to one bigger action move. The reaction into the line, and that gives you that perfect setup to go short off the blue line to grab some of the subsequent action move. And just going with some of the basic concepts I've been talking about my whole career, you can see it right there. So this is, you want to avoid getting into that reaction, and the blue line gives you just enough to adjust around. Push that entry up over the line a little bit. There you go. So unleaded gas. What else? Okay, my work is done. Bye, everyone. Here's the Dowie Mini. Yeah, look, it's still going. So that just triggered in right when I was logging in due to just the TradeStation issues I have now. I'm using Windows 7 on this machine and TradeStation 9.5, and it's probably getting a bit long in the tooth. It just stopped out right there. Let me know if you have any questions. Good question, John. Let's check that out. So, what time are you looking at? Stop and reverse. That's another good set of questions there, Johnny. So, I'll start with your first one. When are stop and reverses good? When they print on your chart. So nobody knows what's going to happen next. You can't like go, oh, maybe this is good. Oh, maybe this isn't good. So then you have to have other things that we combine with that, which I'll talk about. 934. Let's take a look. Well, I have this one at 933, and I could see that it's blue. So you said you have a blue, you have an oversold condition and no long trade. So the next thing to look for would be a filter maybe that gets in the way of it, that prevents it, or maybe there was another earlier setup that used that, or maybe there was a pink bar that barely poked up that eliminated it. If you make your, I don't know if you could do this in Ninja, but if you can make this bigger like so, then you could really look at it and see. You have both OSO and OB, so one's gonna offset the other. I mean, if you have it oversold and then it gets overbought before the oversold prints an overbought trade, then one replaces the other. I believe that's how it's programmed. There's got to be some logic to it, I'm sure. I mean, obviously there is. So, Johnny, a lot depends on the strategy that you're using with stop and reversals. I know with Catapult, you have to be careful because you can get like a long, a short, a long, like you could get one bar after the other if it's really, a choppy whipsaw scenario. And without seeing it, it's hard to know how to explain how you would handle something like that. But for the most part, you have to believe the stop and reversals because at that point in time, the trade setup is the trade setup. And then what we do is we try to make little adjustments. We want to stay with the trade that we're in if we can. But if the market's turning and going the opposite direction, we also, we don't want to be so stubborn that we can't change our mind and flip over to the other side. So usually we'll adjust the entry a couple ticks. The reversing trade entry will adjust it a couple ticks. It depends on the market. I mean, I'll make as big as a 10 tick adjustment on unleaded gas, for example. But usually it's 2 ticks on markets like crude oil or Dow Mini. And then you look to see if there's another smart adjustment. Could you do one more tick to get around a swing level, or another tick or two to get through a key level? That sort of thing. And okay, John, glad you figured it out. On my YouTube channel, I have a pretty good video on stop and reversals, I believe. I have to look and see. But the thing is that we're not smart enough to know what's going to happen next, right? I know I'm not. Nobody is. That's the whole point why you use a trading strategy. And so from that particular concept, just from starting from that idea, who are we to decide what's good and what isn't good? It's easy to know after it happens, but how do you know on the right edge of the chart? You don't. There's no way to know. So then what? Then we have to make decisions based on that concept, right? That makes sense. Some strategies produce stop and reversals more than others because they're more sensitive. So one of the reasons I was late getting into the session was I wanted to show you some catapult energy stuff because there's some interesting, some of these trade plans that I presented last summer. They're just knocking it out of the park to this day, and I was going to bring some of those up. Maybe I still can. Let me see if I can get you a video on my channel, on this YouTube channel, Johnny. Yes. All right, so I got two different ones I'm going to give you. All right, so here is one video. Oh no, that's the one. Sorry. The other one was something different. The how I place trades, this one might help too. The way I use the matrix with stop and reversals actually is appropriate. So let me give you that one. Something that could be practiced in a sim account. That's definitely the type of trade you want to set up, practice a lot. So, question the point of using a strategy. And so, with not knowing, how do I test stop and reverse and put it in English in my. Well, okay, so a stop and reversal, think of what that is. Stop. So, first you stop out of the original trade, and then reversal. You get into the next trade. So, what you're doing is you're moving your original stop to the point of the entry of the reversal trade. So, let's just pretend what we're seeing here on the right edge of the chart is a stop and reversal. It wasn't, right? Because it stopped at the trailing stop. But let's say there wasn't a trailing stop. And so you got long here, and the stop is down here. Let's just pretend, way down here. And then all of a sudden, at the right edge of the chart, there's a short trade. So you're going to move the stop from here up to here. This entry to go short becomes a stop on the original trade, except that we adjust it down a little. In this case, I would go down 2 ticks to 07, and I really want to stay in the long trade if I can, so like I said, I don't want to pull into a pullback zone like this blue line. So I can look at the blue line. It's 108.06, and I could even adjust it below that as long as it's not too big of an adjustment. So maybe it is. Maybe going all the way down to 05 or 04 is too large of an adjustment from 09. So my general rule of thumb for adjustments in general is 1 or 2 ticks are okay, 3 ticks sometimes, 4 ticks rarely, 5 ticks even more rare. It doesn't mean it's not appropriate, but a lot of times you could stop and reverse and then the trade still loses, like in this case. So I don't like to over adjust. If we adjusted that down to 04, it hit 04. If you adjusted it down to 03, it would have kept you long. But you just don't know that until after the fact. So obviously this wasn't a stop and reversal. I'm just trying to use it as an example. But ultimately, the stop, just think of what it is, stop and reversal. So the first trade stops out, the second trade reverses in the opposite direction. That's all it is. It's 2 trades. So I think you're overthinking things. How do you put it into English? It's 2 trades. The first one loses. The risk is reduced, right? It doesn't come all the way down to the original stop. It stops out where the adjusted entry is to go short, and then you get short. In this unfortunate case, it would have been 2 losses in a row. That could happen. That will happen. Stop and reversals always give people problems. But here's another scenario. When you stop out of what would have been a full losing trade and you only lose a percentage of the first trade, but the reversing trade is a full winner, that's a good thing. Now you're cutting the loss on the first trade and you're getting a full winner on the second trade, and the 2 trade sequence becomes quite profitable. And that happens a lot also. So in the end, you're forced with making decisions at the right edge of the chart, like with all trades, right? And there's no way to know what's going to happen next, so we got to follow our plan. Some people go, I don't like stop and reversals. I'm not going to do them. Okay, test it. See what happens. It's really easy to compare 2 trade plans, one that takes stop and reversals and one that doesn't. And you could test it side by side, and in the end, you'll find out which one performed better. And I would venture to say that a lot of times it's going to be a wash. You're going to have one plan that maybe performs a little better than the other, but there's going to be times you wish you didn't stop and reverse, and there's going to be other times where you're really happy you did. And how do you know when that's going to happen? Well, after it happens, you're going to know. So then you have to settle in on the results of your overall trade plan over time, and in there are some losing trades. The reason the pink trade on the chart was not a stop and reverse because the first long trade was already a winner. Well, it was not only already a winner, but it also had already stopped out at the trailer. And then it reversed, but it's not a stop and reverse. It's a trade that stops out, and then there's a second trade to go short, but you're already flat. So a stop and reverse is when you're live in one trade, and you have to reverse out of it into a trade in the opposite direction. Ranjit, it might have been a reaction, but let's face it, there are such things as reversals. Trades and markets do reverse. We could take the similar, you can find all kinds of other examples where the stop and reverse, there are no stop and reversals on this chart, so it's not really the best chart. We could maybe try to find one elsewhere. But a lot of times you're in a trade that's just destined to lose, and the reversing trade is the one that's going to win. So you're right. Now, after the fact, we can see that, but also, really you don't know. But all right, it's not really a good example either. I'm trying to find an example, but we're not seeing any, of course. It's like when the doctor's in the house, you're not sick anymore. If we see a stop and reverse, I'll point it out and we'll talk through it. Or if you have an example you want me to look at. It's a really good discussion, and I understand it gives traders fits. And it's something you have to practice and get comfortable with. There's no way to avoid it unless you just don't take them. Or you have some other rules that you come up with. I mean, my rules are not the end-all rules. You can come up with another method of how to deal with stop and reversals. Clearly, if you're running the risk of trading into a reaction and you'd rather stay with the prevailing trend, which is what Ranjit is implying, there's nothing wrong with that way of thinking. And sometimes you'll be right and other times you'll be wrong. It's just all there is to it. Here's an interesting stop and reverse on the pound Aussie right here. I mean, there's no real clear trend, right? But do you want to get long right below the 200 moving average? I mean, in this case, I would adjust the stop and reverse to the actual stop of the yellow trade, and then I would move it 1 pip off of it. I'd probably move everything up to 7, 7, 8, 9. And I don't like to get in at 8, 9. I'd rather get in at 9, 1. But I don't want to over adjust. When this trade is destined to lose, it did just lose. And now it actually should be long. And that's a case of getting out of the short and into the long right there. The short's a loser. Even if the long wasn't there, it's still a loser. But we also have a long trade. So now you're long. If you adjusted both up to 9-1, you'd still be short because it hasn't hit 9-1 yet. And Ranjit, you are exactly right. That was the next thing I was going to say. It's almost as if you've been listening to me and what I've been saying over the last X amount of years. Whatever you choose, you need to be consistent and do it the same way every time. Because in the end, you want to get measurable results. And if you're always wishy-washy, well, it didn't work last time, so I'm not going to do it this time. Oh, it worked last time. I should have done it. Now I'm going to do it different this time. Then you don't even have a trade plan or anything. And so you need to do it the same way every time. And maybe if you have a specific market and a specific strategy, it pays to test both with and without stop and reversals, especially if you're learning, so you can see it for yourself. Because ultimately, you have to believe in what you're doing. That's like more important than anything. And you can't just assume one thing will work better than another. You don't know that. And you might guess right and you might guess wrong. Or you might just have a method that you're comfortable with, and sometimes it won't work. And that's what's going to happen because nothing works 100% of the time. So stop and reversals, like anything else, it'll drive you crazy if you let it. I don't let it do that. I've already surrendered to the fact that the market's going to do whatever the hell it wants, and I'm not going to argue with it. Being consistent, what are some examples of trade plan instructions, rules I might consider? Well, the adjustment, the stop, any type of adjustment is a good rule to consider. So some people will keep pushing that entry or that stop so far because they don't want to get into the trade, for whatever reason. And that's never a bad idea. And you need to have some sort of rule that governs what you allow as far as adjustments go. And like I said, mine's pretty simple. 1 or 2 ticks are okay. 3 ticks sometimes. 4 ticks rarely. 5 ticks more rarely. It just depends on the market too. Like a 5-tick adjustment on unleaded gas or heating oil is not that much. Each tick is less than half of a tick on crude oil, for example. So you have to kind of put it into context to the chart you're trading. But that's the type of rule that you would consider to answer your question. As far as other rules go, I mean, the trade strategies and the trade plans that are presented on the member sites, they already have rules. So I would say start with those. And as you learn and gain experience, you might make small little adjustments to those rules here and there if it suits your needs. And if you don't know if it suits your needs or not, then you probably shouldn't change anything. Most of it's common sense. You see what's happening, it's right there, and after you've lived through it 150 times or whatever, you're probably more equipped to make a decision to change something based on your own experience. But the rules are already in the trade plans, they're already taught in the training. Sometimes and rarely I could use those 2 words in my trade plan. Better start with trade plans from the members. Yeah, I mean, all right, so the thing is what you're touching upon is the 5% art to trading. So like 95% of what we do is mechanical, right? What do we trade? What time do we start? What strategy do we use? Where's the entry? Where's our power of quitting goals? When do we quit, for example? All that is mechanical. The 5% art to trading can be reduced to mechanical rules so that maybe it becomes a 1 or 2% art to trading. But it comes from that 5% art. And making the adjustments, like 1 or 2 ticks, sometimes, rarely, everything I just said to you, falls into the 5% art of trading, but you reduce it down a little bit and make some of it mechanical. So 1 or 2 tick adjustments you could do without struggle or thinking too much. But when you do adjustments that are more than that, you start screwing up and distorting your trade setups, because the more you make an adjustment, like on the entry, it messes with your money management. Maybe target 1 or the money management would have been that 10 tick minimum that you need, but after you make a 2 tick adjustment on the entry, now it's only 8 ticks. And so what do you do then? Well, now it has to go 2 more ticks past that before you can move your stop to break even. And what if it only goes 9 ticks and then comes down and stops you out? You would have had a 1 tick break even, and now you have a full loss. Those sorts of things will start happening. And so you have to be very careful with adjustments. Some traders are like, you know what? It's easier for me not to do any adjustments at all. There's no right or wrong answer except for what you come up with your own testing and what you feel comfortable with that you can execute on. Well, I'm saying with the 5% art to trading, you have rules that you don't program necessarily into the software. So these adjustments, we could use the software. I mean, there is a stop and reverse adjustment tool on some of these strategies. I just don't use them because then it adjusts everything. And I only want to adjust the one trade I'm in. If you adjust everything, it changes all the sequence of trades that follow. So for that reason, we do it in our heads when it happens manually. But you could also have some rules that govern your adjustments or your 5% art decisions. And because you're now putting rules on them, in a way you're making them mechanical, even though they're not programmed. But they're still mechanical rules. And so then that's what I mean by reducing the art of trading down to 1 or 2%, because you've taken some of those artsy rules or artsy maneuvers and you've reduced them down to additional rules that you can follow. So now they become mechanical. Does that make sense? You're not supposed to know all the answers, and that's the other thing. Don't forget about in the 12 powers, one of the 12 powers is the power of surrender. Some things you cannot control. So don't obsess over trying to control things. Yeah, so the 5% art to trading are the little decisions that you learn with time. And one of those is real easy when you think about it. Let's say you have a long trade and the entry is 2 ticks below major resistance. Does it make sense to get long 2 ticks below major resistance? Or does it make more sense to adjust the entry a little bit past the resistance to see if the price could push through before triggering you into the trade? And that's something you learn to see on the chart. Maybe the little adjustment prevents you from getting long on a trade that's up against resistance just because you made that 3 tick adjustment. So if you think about it, think of it as an insurance policy. And insurance costs money, but it also gives you value when it does its job. If it doesn't do its job, you pay the premium. So in that last example, if it pushes through and actually triggers in, you pay the 3 tick premium. That's the cost of insurance. But if it doesn't push through and the resistance holds where you would have triggered in, but because of your adjustment, you don't, you either stay flat or you stay in your original trade, and then it heads lower and heads back down and ultimately wins or something else happens, doesn't lose because you stayed flat, that then your insurance policy paid off in a big way. You see? It's another way to look at it. So here's a good example happening now. Let's see. You have a short trade, possible long trade. Hasn't hit the original entry yet. But the original entry is at 91. I want to protect the trade I'm in. I want to stay short. But I also have to respect the fact that the market could be turning. And if so, do I want to just ride it out to a full stop loss? Or do I have to respect the next trade in my trade plan, which is a long trade, but not at 91? I would move it up to 93. But then at 93, I've got my 20 SMA, which marks pullbacks. So I'll want to get long at 94. So that's a 1 tick adjustment. And look what happened. It got long at 94 and then hit a full winner, target 1, target 2. Right in front of us, right there. It just happened. Now, it could have stopped out for a full loss, and then we would have missed the winning long trade. Of course, the long trade did cancel, let's face it. It actually canceled, so it's not the greatest example. You had 2 bars closing on the other side of the balance line. It canceled the setup. So, still not the perfect example. But to make it a perfect example, I can go into the calculator and change an input on the cancel bars from 2 to 3. And now it becomes a perfect example. See, watch. There. So, of course, it would have been better to get in without the adjustment, right? Because why pay 3 more ticks? Well, that's your insurance policy, because it's possible you could have stayed short and it could have went the other way. Here's a case where you pay the insurance, but it still ends up being a profitable thing to do. You get out of a losing short trade with a, dramatically reduced loss. It's at least 35 to 40% less of a loss, even with the adjusted entry to go long, and then that comes up and hits targets 1 and 2. You see? So there's an example, even though I cheated the system by changing an input, but now you can see it working. On the other hand, if it didn't get long, then you would have been happy to stay short with the adjustment. And then there's always a scenario where it gets long and then it goes down and you lose on both. That happens too. Here's another stop and reversal. So long at 13, you have major resistance up here at 17, but you can't really adjust from 11 up to 18. It's just too big of an adjustment. 1 or 2 ticks, okay. 3 ticks sometimes, 4 ticks rarely. Where does it say to adjust 8 ticks? On crude oil, doesn't say that. So maybe you wish you stayed short. Maybe you're glad you flipped to long. Now you can see you wish you stayed short. But what you really are happy for are your original power of quitting rules, because then you would have already finished. You would have had your slightly profitable first trade of the mini session here. And then if you kept going, you would have had a reduced loss and then a full winner. And you would have already done your trade plan trades, which keeps you out of this mess also. And that's part of it as well, right? We're looking at hypothetical trades that really don't mean much because they're not even part of our trade plan trades. So there is that, right? And so my activities for later today: watch the YouTube link, return to member site to see trade plan examples, test my own different scenarios. Don't overthink things. You forgot to put that in there. Ranjit, before stop and reverse, would you ever go and have a look at a longer term chart to see if there was a general market direction? Yeah, Ranjit, that's also a really great thing. And that's helpful sometimes, but it's not helpful other times. If you're able to do that and come up with some sort of rule that you can prove is going to help your result, then I would say do it. But more often than not, you end up throwing too many ingredients into a recipe that makes a good tasting dish, and all of a sudden it doesn't taste so good anymore, and you can't repeat it. If you just are, trying to get some general sense of stuff, but you have no way to define it and create a rule that you can follow, then you're in trouble, because you'll never do it the same way every time, which is your own advice, which you're just repeating my advice, and it's good advice. But you have to be careful you could actually do that, right? So you could get general market direction, and that still doesn't mean the market's not going to turn around. And let's face it, when you have general market direction, you still have up and down and up and down inside of that market direction with faster charts, right? So as long as you're sure it will help you. What if we're looking at a trade plan already and it grows your account so much that all these extra suggestions and things we're talking about and desires to avoid stop and reversals don't help? And instead you end up messing with a trade plan that's just going to make you money if you surrender to the fact that some trades will lose. So the bigger thing and the bigger question I think that's worth asking is, what are you afraid of? Because if you're trading to avoid losing trades, that's the wrong reason to trade in the first place. You should be trading to make money. And you don't make money whether a trade wins or loses. You make money if the trade plan grows your account over time. And if you could quit your session with a winning result a vast majority of the time with minimal trading. So if you could stay on point with that and then pull up a higher time frame chart and establish some sort of rule set to follow that will increase your winnability on a trade plan, then that's a good idea. And it's not easy to do. It really isn't. But it can be done. And if you can do it, it's not going to be a bad thing. It's going to be a good thing. You're going to work harder. It might be worth it. So I'll give you an example of a possible stop and reverse. This is even more complicated because it involves options. And it's happening live right now. So I'm going to show it to you. Here is a chart, a commodities ETF, Invesco Agriculture Fund. I took a chance and got some options because it was trading up at 3-4 million. Now it's less than a million. Maybe it'll hit a million by the end of the day. It's borderline whether you should even be in options, but I decided to go for it with options that are further out, like January 2024. January 24. Yeah, January 2024. So I got over a year, way too much time, but I just decided to do it. And I got long, not on the first bar here, but I waited for it to pull back. I think on this day is when I got filled. And then a short happens. So what I did was I went ahead and I changed my order that if this stop, if the price of the stock hits slightly below this entry, and what I did was I looked to the left and I think I lowered it. I don't remember. It's on my other chart. But anyway, I put in I moved my stop from down here. Actually, it's right there. I moved it below this bar and I put my stop where the green line is, where that orange and green line. So notice the adjustment from the entry all the way down to there. So here's a case where the 1 or 2 ticks, sometimes 3, rarely 4, doesn't apply because this is a bigger chart. This is a stock and equities chart. And I want to stay long. And I believe that the longer term trend is up, Ranjit. So, looking at a weekly chart, for example, you can even see the prevailing trend on this chart. It's up. We all know there's inflation. We all know that commodity prices are going up. So we already know all that. That doesn't mean a short trade isn't going to work. Still could win, and the trend could still be up. But I also want to stay long if I can, protect the trade I'm in, and respect the fact the market could be turning. But I see support down here at the bottom of this red bar. You can see the spike. You can see it come down. And so why do I want to get short slightly above it? I want to see if it could push through. And so far, it hasn't been able to push through. And now it gaps up. So there's a case where I employed the same thing I'm teaching you guys, a stop and reverse adjustment, the 5% art to trading. And I'm going to try to protect the trade I'm in and stay long, but be ready to go to short if I have to. And now if I do go short, I have to decide which put options to buy. And because these are daily charts, I decided to wait. I mean, I didn't put a conditional order in for that. I'm going to let one thing happen first and then assess what to do after. But it looks like with luck, it's going to cancel itself out and I'll just stay long. Yeah, I mean, is it a leap option? Maybe. I mean, I don't know. It expires on the 24th, 2024. I mean, I don't. I mean, is it a leap option or is that just a term? It's like I've never been able to get on my platform and go show me the leap options. I don't know how to do that. I just picked one that was as far out as I can go. By the way, if you guys like what you're hearing, please hit the like button. It's always helpful. So anyway, that's a real life example of a stop and reverse with a swing trade and with options, but the same concept. And by the way, that's Counterpunch Trader, in case you're wondering. So one of the reasons that I was a little delayed getting in was because I was trying to open up some of these energy future charts on Catapult because I wanted to show you a few things, and I was just taking too long. I had I had an unleaded gas I wanted to show you, but we could look at heating oil. And remember, I presented these last summer, August, I think. So has anybody been paying attention to these charts, because they've been like on fire. They've been amazing. And the unleaded gas is like a straight line up, and so I'll start with this one. So this only could look back so far, right? This is looking back to November. But when I presented this, it was in August. And so it was looking back 90 days, 120 days, whatever, before August. So speed forward now to March, and it's looking back to November. And that's what it looks like. I don't know about you guys, but that's pretty exciting stuff. And it's hitting like equity highs every single day practically. And it's sporting a 2.48 profit factor, 76% win rate, 739 trades, $57 average net profit after all wins and losses. People always say there's no holy grail in trading, and there isn't, but then there's this. Well balanced up and down. It's hard to argue with that. Where's the drawdown? I don't know. Yeah, it's heating oil. Yeah, it's a thin market. Yeah, you got challenges with spreads at $4.20 a tick. Yeah, there's a learning curve. Yeah, it makes a lot of money. 7,000 contracts is kind of low. It's not that many. So you have that to contend with. No doubt it's got challenges. All trading has challenges. Still early in the day, of course. Here's another one. These are all different variations to the theme. This one maybe not quite as good, but still good, but not as good as the first one. But I'm saving the best for last, of course. Why is that happening? Jesus. I hate buggy systems. All right. So this one also not as good. It's good. I mean, the 177 profit factor and a 68 win rate, a 45 average net profit. You need more with heating oil, but it definitely gives you in a perfect world, who doesn't want to be in that? All right, then there's this. Ay. This does not want to work well, does it? This one had a little bit of drawdown, but then recovered like crazy. This one's the least good, although it's got the fewer trades, but the smaller average. Still pretty good profit factor. Not the one I'd probably choose, but check this one out. And I wanted to show you unleaded gas because that's got another story to tell that's pretty impressive. But look at this one. This has a $200, $237 average net profit per trade, a 79% win rate. So it's like winning 80% practically. Look at the profit factor, you guys. 5.81. 5.81. Are you kidding me? And this, again, a trade plan that was presented last August. It only has had 2 losers in a row. It's 113 in a row. And that's the equity curve since November. Yeah, it sure would be great if this was trading 100,000 contracts a day and produced like this. If only we had control over stuff like that, which we don't. Anyway, I will try to get the unleaded gas up for the next session, and we'll talk through it. But let's look at the settings on this one. So remember, this is Catapult. It's like one setup. One of the things that make it interesting, let's see. First of all, this is an evening trade plan. So that's interesting. 1940 to 2400. So you trade this one at night. And it's only looking at a target 4 and a trailing stop, and that's it. So 2 contracts only, power of quitting 2. Basically, it's 2 trades, win or lose, because you have a maximum of 2 trades, a maximum of 2 losing trades, and a maximum of 2 trades with a positive result. This trade plan is 2 trades a day in the evening. That's what it is. Well, okay. Maybe you adjust your sleep schedule. I don't know. It is what it is. If we look at this other one, which is also really good, this first one, this one goes to target 3 and trail, but it's got a power of quitting 6 winners or 4 losses, whichever happens first. So this is pretty robust, but it only goes from 9:05 in the morning to 12 noon. So there you go. I mean, that's not a bad curve, is it? This one still gives you the numbers you need. It's still sitting at the $57 average net profit with a 2.48 profit factor. I mean, you have something that can produce like this, and you could sail off into the sunset, wherever your sunset is. Because you only need, here's the thing, and you guys may have seen this presentation. Maybe I should plan on another one. If you can make $50 average net profit per contract per day, $50, think of that. 5 ticks on crude oil, however many ticks on heating oil after slippage, call it, 17 or 18 ticks, maybe. $50 average net profit. If you start with 20 grand and you raise, after you make your first 5 grand, then you start increasing your position size with 2% of your account value. You start giving yourself a raise and increasing your position size. Within 24 months, you will have traded yourself to a $250,000 account and a $10,000 a month income. Just making $50 average net profit per contract per day. 5 little crude oil pennies. to put it in context. On average, right? That's average of all wins and losses. So this says average net profit, which factors in all wins and losses, $57.40. You even have a couple ticks extra for some slippage in there. My example is not a perfect model. It's just meant as a guidepost to put things into context. The power of what we do when you employ smart trade planning and sensible money management. It's the reason we do what we do, right? That's on the Catapult Energy member site, these trade plans. That was a really popular Catapult session, the energies, and for good reason. Any questions, guys? I think we're about done, yeah? All right. Well, thanks for joining me today. Hope you enjoyed the session. Please hit the like button. Everyone have a nice rest of your afternoon. Don't forget, John will be here tomorrow. I'll be here Wednesday. We'll see you then. Bye, everyone.